23, which saw Thanksgiving sales climb by 5.5% as consumers looked to keep stretching their dollar. Toys were popular with parents, with discounts peaking at 27.2%, and electronics, which are expected to be more popular this weekend as people look for TV and computer upgrades, made up more than 26.5% of sales. Mobile shopping also hit an all-time high. Shoppers found their phones were more convenient than their computers to make purchases this year, making up 60% of online sales. So what this tells me is when people were supposed to be enjoying their Thanksgiving, they were on their phone at grandma's buying stuff. The $3.6 billion in online sales showed a 10.5% increase year over year. You know what? That's funny. Reminds me of the days when we as kids and as teens, I remember my mother would look at all the circulars on Black Friday and be like, what happened? What's for sale? Circle what you want. And we didn't have any money, so Black Friday was like the greatest day of the year. It was when things were on sale. And when you were broke, you would stand out in line at 4 a.m. at Walmart, or as my mother used to say, because she was from Boston, Target. Cyber Week is off to a strong start, where bigger than expected discounts on Thanksgiving propelled impulse shopping in categories like electronics and apparel. Vivek Pandya, lead analyst of Adobe Digital Insights, said in an emailed report. So what say you? We really want to hear from you. If you have questions on stocks, bonds, annuities, mutual funds, this year's price cuts had people considering more expensive electronics than usual when compared with preseason sales. They were also trading up when it came to appliances. Some people are getting those washer-dryer combo sets, sporting goods, personal care, and toys. Shoppers are also looking for guidance on their spending habits this year, with people clicking through from chatbots to retail sites and looking at company partnerships, including social media influencers, more often than in 2023. The buy now, pay later installment payment plan options gained more popularity as well, driving $430 million in online spending. Adobe projects that will grow even more on Black Friday and Cyber Monday. Another year-over-year increase from the payment options all-time high last year as shoppers continue to look for ways to manage their budgets. Adobe expects Black Friday sales will set even more online records, predicting $10.8 billion in spending, with electronics as the most popular purchase. Meanwhile, the National Retail Federation predicts 183.4 million people in total will shop between Thanksgiving and Cyber Monday. All in all, it seems like a good retail holiday, Christmas and Hanukkah season so far. Now, how do stocks usually perform between Thanksgiving through New Year's? With the year-end holiday upon us, this from Dominic Dyingson at The Street. Many investors are taking a break from their screens to travel and catch up with family and friends. For the other investors, particularly professional ones, like fund managers, the year-end holidays are an important period of portfolio management that may be characterized by getting rid of certain stocks to minimize capital gains taxes or last minute editions. Do your capital losses offset income? We're going to talk about tax loss harvesting later on in the show. And if you want help with year-end tax savings review, you can just call my office, 888-988-JOSH, for the free review, or raise your hand on X. We are on X Live at YourFinancialQB. You can follow me, or give us a call, 800-321-0710. So we're talking about tax loss harvesting in a minute, but first, Thanksgiving through New Year's. Now, how has the Standard & Poor's 500 index performed during the period from the market close the Wednesday before Thanksgiving to the last trading day of the year, the last 20 years? It's interesting. There's been an annual change, positive change, in all but 4 years. So this seasonality chain is because the market likes Santa Claus and the nativity of Christ and Hanukkah Harry. However, or the mensch on a bench. 2004. So this is pretty interesting. If you look at the positive years, there has been only 5 negative years. I said 4. That's 4 in total, but 5 for this. So check this out. 2005, negative 1.37. 2013, negative 0.67. 2015, negative 2.15. 2018, negative 5.4. 2022, negative 4.66. All of the other periods, this is from Dominic Duigason of The Street. Basically, there have been more gains than losses during the Thanksgiving through New Year's period. It's pretty interesting. So Christmas is kind to stocks. Now, Tom McClellan, we'll try to get him on. He calls the Santa Claus rally not the period from Thanksgiving to New Year's. He calls it the last few trading days of the year. And he says that's even more positive. But let's just go do with what everybody thinks. During the last 20 years, the market typically eked out small gains or losses in the holiday period from Thanksgiving to New Year's. There have been more holiday season gains than there have been losses. 15 verse 5. The biggest increase during the holiday period was 8.3% in 2011. The biggest decrease was in 2018 at a negative 5.4%. But even in that 2018 year, I believe the last week was good. Not 100% positive, but Tom McClellan always points out that the Santa Claus rally is really not this period. It's the period right after Christmas. It's the trading days between Christmas and New Year's. There have also been a few instances when the market performed better during the holiday period than it did during the entire year. In 2007, the S&P's gain during Thanksgiving and the New Year holiday period was just slightly better than its annual increase. We'll talk more about this and tax loss harvesting and year-end tax tips for you. Give us a call, 888-988-JOSH, for the free review, 800-321-0710. If you have a question, we're live taking your calls on All Matters Financial. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check. Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org.
We're back. This is Josh Jelinski, the financial quarterback. Give me a call, 800-321-0710 if you have a question. We're talking about billionaires taking over professional bull riding. Does that appeal to you, Jim?
No, not at all.
And then, do capital losses offset income? We're going to give you a couple tax loss harvesting tips. Tax loss harvesting is a common year-end practice among those in higher tax brackets who are heavily invested, but in many cases, this practice can help lower-income investors as well save on their tax bill. But first, the Christmas rally. In 2008, just at the tail end of the 2007 to 2008 financial crisis, the S&P rose 1.8% during the holidays, compared to 38.5% decline for the year. 2018 and 2022, the loss was smaller than for either year. In 2011, the market gained 8.3% versus being unchanged. On the flip side, for the periods in 05, 14, and 2015, the market underperformed the entire year. For the most part, however, the market's overall performance has been better than its performance between Thanksgiving and New Year's, but still, this period has generally been positive for stocks, 75% of the time, according to Yahoo Finance. So, what do you do if you're trying to tax loss harvest? So we're going to give you some year-end tax tips, RMDs, RMD bunching, tax loss harvesting, and anything you want to talk about. Just call me, 800-321-0710. We're live. And we have our operator standing by to schedule your no-obligation review. So according to Jeremy Salvucci of TheStreet.com, tax loss harvesting has been a common year-end maneuver among wealthy, older investors in higher tax brackets. In simple terms, it's a year-end purge of unprofitable stocks performed to offset the capital gains taxes, which are profits from winning stocks realized throughout the year. So let's say you have a dud stock that has not done well in the latest rally. A great thing you could do is sell that stock against a winner, rebuy back the winner or the loser in a few days. I think it's about 30-day wait period, because you got to make sure you don't run afoul of the wash sale rule. I'll talk more about that later. But let's say you had a stock that didn't do well, and you had a stock that did do well. Let's say one stock lost $5,000 while another gained $5,000. You could sell the $5,000 in winnings against the $5,000 in losings, and it could be a tax-neutral event. If you're a newer investor, however, you may not be familiar with the practice. But with the advent of commission-free trading and fractional share trading, many of you are having to learn that there are tax implications of owning stocks. Like, duh, but people don't remember that. But you'd be amazed how many calls I field during the year. I didn't know I had to pay tax on that. Well, what do you think? When you have, I'll give you a little tax primer. When you have an IRA, 401k, 457, 403b, or tax-deferred annuity, every dollar you take out is deferred income that you didn't pay an income tax on. So when you take constructive receipt of the money, you get hit with income taxes, provided there's a gain in an annuity, but all the other things, every dollar you take out is income taxable. But smaller scale retail investors can also benefit from tax loss harvesting. And this is an IRS reviewed accounting maneuver. And how exactly does tax loss harvesting work? So when an investor buys a stock and it goes up in value, that's called a capital gain. If it goes down in value, that's a capital loss. Only once the stock is sold, however, are losses or gains realized, and only do realized gains or losses affect your tax burden. You might have heard the phrase, it's a paper loss. Well, if you didn't sell it, you can't take the write-off on your taxes. Capital gains and losses come in two forms. Long-term are when you hold something for longer than a year, and short-term gains and losses are things held for less than 1 year. Investors have to pay taxes on realized capital gains because they are a form of income. When it comes to paying your favorite uncle, Uncle Sam, short-term cap gains are taxed at the same rate as your ordinary income, your marginal rate. So it's your highest bracket. Whereas long-term capital gains are taxed at lower rates, which can be as low as 0% for those who fall into the lowest tax bracket. So that could be very helpful. So investors are more likely to sell winners than losers. So for many, realized gains tend to exceed realized losses as the end of the year approaches. After all, most average investors tend to hold on to stocks that have lost value in the hopes that they will go back eventually. Tax loss harvesting is the practice of purposely selling stocks that have declined, as painful as it might be, in order to offset your capital gains or ordinary income so that you pay less in taxes. For instance, if an investor realizes $4,000 in cap gains, but purposely sells losing stocks to the tune of $2,000 in capital losses before year end, they will only be taxed on the $2,000 of gains that weren't offset by losers. Also, if an individual doesn't have any realized capital gains, or if their losses exceed their gains, they can use losses to offset $3,000 per year of ordinary income. For an individual who sits right above the lower end of a particular tax bracket, a $3,000 reduction in income could push you into a lower bracket and make a difference on a major tax bill. If capital losses exceed $3,000 after gains are offset, the remainder of the losses can be carried over to other years at the filer's discretion. This is called capital loss carryover. So we're talking about tax loss harvesting, taking all of your financial questions at 800-321-0710, or if you're live on YouTube or Twitter or X and you have a question, be sure to raise your hand, put your question in the comment box, or raise your hand on X. We'd love to bring you up on stage. Let's say investor X, a recent college grad, makes $47K per year at their job as a server at a restaurant, landing them in the $44,726 to $95,375 bracket. This is a marginal bracket of 22%, using money from an inheritance they get into investing in the beginning of 2023, primarily buying individual stocks and cryptocurrencies. They sell well-performing stocks over the course of the year, pocketing gains to the tune of $2,000. Unfortunately, they also buy what they think is a promising cryptocurrency called Dolphin Coin near its peak in February, and it plummets in value shortly thereafter, resulting in a $5,000 capital loss. If investor X holds onto their position in Dolphin Coin, hoping it will go back up in the future, the $2,000 capital gain from selling the stock would be taxed at 22%. And their ordinary income will be taxed progressively, with everything above $44,726 taxed at the marginal rate of 22%. However, if this investor decides to liquidate Dolphin Coin for a $5,000 loss before year end, they could use $2,000 of that loss to negate their $2,000 in realized capital gains, resulting in no capital gains tax, and use the remaining $3,000 of their loss to reduce their taxable ordinary income from $47K to $44K, pushing them into a lower income tax bracket and lowering their marginal tax rate for the year to 12%, which is a significant discount. While tax loss harvesting is an above-board practice, there are certain things you can't do in the eyes of the IRS, namely the wash sale rule. Many investors like to hold on to struggling stocks instead of realizing a loss. So some might be tempted to repurchase shares of a stock they just sold at a loss in order to offset their gains soon after selling. The wash sale rule states that an investor may not claim a realized capital loss on their sale of a security used to offset their gains or income if they purchase that same security within 30 days before or after the sale. So wait 31 days if that's you. This includes buying options, stocks, derivatives, or buying shares of an ETF that include the stock or stocks in question. This provision prevents investors from taking part in performative tax loss harvesting, in which they only pretend to realize a capital loss by selling shares of an unprofitable stock and then simply repurchasing them afterward to create the original composition of their portfolio. What else do you need to know about tax loss harvesting? We'll talk about that when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check. Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org.
We're back. Taking your calls on all matters financial. If you have questions on stocks, bonds, annuities, mutual funds, make sure you call us now. We're taking your calls live, unscripted, uncensored, shockingly raw. We always love our listener calls. You make this show what it is. Give us a call, 800-321-0710, 800-321-0710. I really want to hear from you. So if you got a call, we're taking your calls all hour. Now, current year capital gains and losses can be recorded on Schedule D on Form 1040 of an investor's tax return. Capital gains and losses are calculated based on the cost basis of the investment in question. The cost basis of an asset is its purchase price, including any associated fees, brokerage fees, sales loads, etc. Capital gains and losses represent the difference between an asset's cost basis and the proceeds received by an investor when they sell it. Is tax loss harvesting worth it for you? Whether tax loss harvesting is a good move for any individual really depends on their individual circumstances. For some, I've seen it be a bad move because they never remember to buy that other stock in 31 days. So you want to make sure you don't run afoul of the wash sale rule. You also just want to put a timer or an alarm on your phone if you really do want to buy back something. Happened to me one time. I sold something that I regret selling to this day because I needed money for various things, and it was something I forgot to rebuy back just because I was so busy helping my individual investor clients. So it gets to a point where if it's something you really want to hold for a long time, maybe you don't sell it. For many lower income investors, though, a high tax bill, especially one that is unexpected, as might be the case for a newer investor not used to paying taxes on realized capital gains, things can be a bit of a hurdle, especially if expenses are high and savings are minimal. Cases like these, tax loss harvesting can be a good way to maintain financial stability in the short term. If you plan to reinvest the money you might save on your tax bill using this practice, the answer is a bit more complicated. An investor who wishes to keep their asset allocation about the same as it was before they sold their unprofitable stocks might be tempted to repurchase the same shares after the 30-day wash sale period. By doing this, they're essentially taking a tax discount now on something they hope to sell later for a profit, at which point they will have to pay capital gains tax anyway. That being said, the market is unpredictable and volatile, and everyone invests for different reasons. And, seek qualified help from a CPA or your accountant. Also, if you want to take us up on the tax loss harvesting review, call us at 800-321-0710 for the listener call-in questions, or 888-988-JOSH. Operators are standing by live to schedule your no obligation tax loss harvesting or TLH review. In other cases, such as a high interest rate environment or during a bear market in stocks, it might make sense to put the money to work in a high yield savings account or government bonds or a fixed annuity to secure a guaranteed return over a period of time based on the claims paying ability of an underlying issuer, rather than the reinvesting in individual stocks. Whatever the case may be, it's always a good idea to consult a financial professional when deciding whether or not tax loss harvesting is the right decision for you and your own personal situation. So we'll give a free review to those of you who call us at 888-988-JOSH. Now, you can be in the zero bracket. This is pretty crazy to think about this. If you're married and you make $194,000 a year and you sell stock for a long-term capital gain, that is a tax-free event. If you're single, make under $47,000, no long-term capital gains for 2024. Want to check with your accountant to make sure that's you, but it could be very attractive. Now, short-term capital gains rates are very different. They follow your income, so they can be as high as 37%. So there's a lot we want to talk about, but I always want to hear from you. Next up, we have Darren. Go ahead. You're on with Josh Jelinski, the financial quarterback. Go ahead, Darren. Darren. Okay. I don't hear him. So if he calls back, he can. Okay, billionaires are taking over bull riding. Egan Durbin minted a fortune making risky bets on companies such as Dell and Skype. This from Chelsea Delaney of Yahoo Finance. Durbin and his wife, Abby, bought the Austin Gamblers bull riding team about 3 years ago. They have to watch competitions from separate rooms, and often he doesn't watch at all until it's over. The most stressful thing in my calendar year is watching this thing. So this guy is the head of Silver Lake, which is a tech-focused private equity firm. Durbin is part of an elite group of billionaires transforming the iconic sport of the American Wild West. Some are longtime sport investors looking for the next big pro league, such as NASCAR. Owner Richard Childress and the Fisher family, owner of the Oakland A's, moving to wherever they're moving now. Others have serious Wall Street credentials. Avenue Capital bought a bull riding team earlier this year, wagering that big media deal would draw more deep pockets into the sport. It's attracted a group of investors that's pretty extraordinary, put me aside, Durbin said. High finance has penetrated deep into unexpected parts of the American economy. Just think of the hit TV show Yellowstone, and now everybody wants to buy a ranch in Montana. Next is bull riding. We'll talk more about that, but first we have Stephen. Go ahead.
Hey, Josh. Good morning. How are you?
Good morning.
So, well, first of
One of my
all,
good buddies,
the Oakland.
Steve's.
Yeah, hey, the Oakland's moving to Las Vegas when they finish when they finally get the stadium built there, and they're going to be like gypsies for a while. But that's not why I called. I'm a fountain of useless information. Anyway, is there any chance that the stretch IRA on inherited IRAs is going to come back?
I don't think so. I don't hear Trump talking about returning it. I think the death of the stretch, killed by the Trump administration, is one of these things that really hurts middle-class wealth, because you could have left, let's say, your IRA to an 8-year-old or a 4-year-old grandchild, and they would have 80 some odd years, depending on how long they live, to grow that money tax deferred. So the stretch IRA, if you're not aware, was you could leave your IRAs to your children or grandchildren. You could still leave them to whoever you want to, but it has to be spent in 10 years, which accelerates the income tax your heirs pay on it. So instead of stretching out the tax bill over their lifetime, it stretches out over 10 years. But it really doesn't. I mean, there's no, other than the investing class, like me and you, there's not a lobby for people who are lobbying for the stretch. So President Trump, if you're listening, please bring back the stretch. It was a great tool. What else? What other questions do you have?
No, that was it. Just a quick question.
Now, there are things.
Love the show.
Thank you. Love you and your wife. Great people and great listener friends for years. The other thing that you got to think about is, well, what do you do if you can't do a stretch? So, because I always want to protect my money from in-laws, outlaws, creditors, predators. So then you have to look at, and when we return from this break, I'll get into what do you do to protect your money if you have a lot in an IRA or 401k or 403b or what I call the alphabet soup of investing. So what you do is you take a little bit out each year. You could Roth it. That goes tax-free. You could do trusts. You could do stocks that don't pay dividends. You could do life insurance. I mean, for years, I was telling people, take what would have been your RMD or your pre-RMD or your post-RMD. Buy a life insurance policy with it. Put that in a trust. Then you can protect your money from in-laws, outlaws, creditors, and predators. They get the money tax-free, so it's even better than the stretch concept. So you don't even need the stretch if you do some of these strategies right. Because the other negative of a stretch or the 10-year rule is it's your kid's money. And you may not care about that, but you may want some control into the grave. So I hope that helps you. And thanks so much, and have a great Hanukkah and New Year, and hope you had a great Thanksgiving, Steve. Next up, we're going to go to the phone lines at 800-321-0710. We have a caller talking about precious metals when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check. Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org.
We're back, and we have Gordon with the question. Go ahead, Gordon.
Yes, Josh. Good morning. Among the four so-called precious metals, and maybe including uranium in that group, what are your which are your favorite long-term investments? And could you explain a little why they are your favorite investments? What are your chosen investments?
Well, I'm not giving you investment advice over the airwaves. You could feel free to call us at 800-321-0710 if you have a question, or 888-988-JOSH if you want my direct, guidance as it relates to your portfolio. That being said, I think uranium, kind of funny. Uranium kind of peaked early in the year and started heading down, and then there's a slight uptick. Global price of uranium, according to the St. Louis Fed, is about 66.51. I do believe in uranium's potential over the long haul. That being said, so do other people, so it already kind of ran up. But you could get uranium exposure in various ETFs, although it's not without risk. Same thing with gold. Like gold as a precious metal, like silver as a precious metal. I don't really see, I know a lot of people like silver. To me, if gold's going to do well, silver's going to do well. I understand there's the ratios and silver bugs. I mean, if you want to have some silver in your house in case the world goes to hell, that's fine, but the idea is silver is the poor man's gold. So what's interesting is silver has not broken its highs of 2012, whereas gold, if I look at a long-term chart of gold, 5 years keeps rising. So I'm a bigger fan of gold over silver. That being said, buying gold and silver now is like buying at a top. you got to be careful. And if Trump, for example, does what people are thinking he's going to do with the $2 trillion that they're looking to cut from Doge, that would cause the dollar to strengthen and gold to weaken. That being said, I'm okay with gold or silver as a part of a kind of an all-weather portfolio. If you want to have 5% in your portfolio allocated to precious metals, or even 10%, can be a good hedge. So I hope that helps you, Gordon. Any other questions?
Yeah, if a person does not have too much money to allocate to precious metal investment, you don't think that silver is the low cost of silver relative to gold is a compelling reason to buy silver?
No, I mean I've been hearing that for a decade plus now, and it didn't prove accurate. So in 2012, for example, looking at Google Finance, gold was around 1,700. It took till about 2020 for gold to regain what it had lost, but then it was off to the races. We're just now regaining what silver lost in the 2012 cycle. So I don't really think silver is the same from a long-term perspective, but it's just me. I mean, there's listeners who like silver, and there's no, I'm not against you if you want to have some. Some people have like junk silver in their house for a rainy day, but I think food supply would do better. So any other questions, Gordon, before we go to Gina, who has a question on gifting stocks?
Just a fast one. You don't think that platinum would be, how would you compare a platinum investment to a gold investment? Since platinum is at least now, significantly less expensive.
I mean, platinum just hasn't been, it's definitely less expensive than it was in that 2012 rally. The rally in 2012 of platinum, palladium, silver was due to people feeling like they missed out on the gold rally and they wanted something else. Maybe that happens again. I just, haven't seen it. So it's like, there's a lot of uses for platinum, namely, beautiful jewelry, and there's other uses to it. Not a platinum expert, but actually half the price of gold right now. So could be a value, but there's not the same. People don't view it as the same monetary value as they do gold or even silver or Bitcoin for that matter. So, and with what Senator Cynthia Lummis is trying to do with the Bitcoin strategic reserve, maybe that's why these kind of other precious metals have fallen by the wayside, because those who are more into that are now into Bitcoin. So hope that helps you.
Very helpful. Thank you very much, Josh. I hope you had a happy Thanksgiving.
You too. Next up, we have Gina. Gina, if you could hold on for the final break of the hour, we'll be back after these messages.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check. Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org.
We're back. This is Josh Jelinski, the Financial Quarterback. Next up, Gina. Go ahead, Gina.
Hi, Josh. I just wanted to let you know, thank you for doing this. I called you last week and we didn't connect, so this week I have two questions.
Great.
Would you be willing to answer both?
Sure.
First of all, I am familiar with stock buying through Schwab. How do you buy Bitcoin? Do you buy it through a person like Schwab?
Well, you can buy ETFs through Schwab or Fidelity. What's interesting is Fidelity actually has a program where you can actually buy the physical Bitcoin and they would custody it. You can also buy it directly through Coinbase or any registered Bitcoin exchange and download it onto your own cold wallet, which, if you don't know what I'm talking about, you could Google cold storage for Bitcoin. See if you learn how to do it. My tip would be practice with like $1. Practice with small increments. Don't put all your money in it. If you're doing cold storage, if you're doing custodied at a brokerage house like Schwab or Fidelity, there are low-cost ETFs, although I'm not recommending anyone buy or sell Bitcoin or any cryptocurrency on this show. So those are some ways you could buy the actual Bitcoin. You could buy the ETFs that trade them, that hold them. You could also do different custody platforms, or you could self-custody. Whole point, ultimately, of Bitcoin is that you have self-custody of your own money, but I realize it's hard for a lot of people, especially seniors, and realize that buying now is, buying at the top, so you just got to be careful and, mind your position. Make sure you don't put, all your eggs in one basket and, avoid, being too risky.
Well, I appreciate your answer. I have no... I would not buy it because I don't understand it, but I really didn't know how you even buy it, so I appreciate that information. My second question
and I would read up on it, read books about it, learn what it is, read the Bitcoin white paper by Satoshi Nakamoto. You could just Google Bitcoin white paper, read it, see if it interests you. People often, that's good. You should always invest in things you understand, generally.
Well, that's my feeling. So that's why I am really not interested in investing in it or finding out more. But I did want to be knowledgeable about how you did buy it. So thank you for those tips. My second question is, in gifting, I believe you can give $18,000 this year. However, if I want to gift stock, I've been burned by gifting stock, and when I gifted it, it went to my cost basis. So can I sell my cost basis in $18,000, which of course is worth much? I would be gifting much more. Is it possible to gift what your cost basis was worth $18,000, which, as I said, now is worth much more? Are you understanding my question, Josh?
Yeah, I don't think you can do that, but you can check with your accountant. Yeah, I don't think you can do that. So, you can gift $18,000. When you gift anything, you gift your cost basis. So, for example, if you gift a house and your house is worth $500,000 and you gift it to your kids and you bought your house for $100,000, they get that basis. So that's sometimes a negative implication of gifting to children. In terms of $18,000, it's $18,000 in real dollars, not, cost based. So if you have $300,000 worth of stock, you can't give $300,000 worth of stock and say it's $18,000. So that's why some people, you want to look at gifting strategies and trusts before you want to gift, not after. You always want to begin with the end in mind. And if you want to stay on after the break, Gina, you could ask me a follow-up. Next up, we got Monica, and we're taking the break for the hour. So call us. Keep calling me, 800-321-0710. You get my free book, The Retirement Reality Check. You can buy it on Amazon, wherever books are sold, or you get it free when you schedule and keep your no-obligation review. Give me a call, 888-988-JOSH, 888-988-JOSH.
WOR and WAXQ HD2 New York, an iHeart radio station. Listen